1. Tax Reduction Basics. In this part, make sense of the federal income tax system. Determine which tax trimming options apply to your situation. Chapter 1. Understanding the taxes you pay. In this chapter, knowing your total taxes, seeing how marginal tax rates work, understanding the term taxable income, being aware of the alternative minimum tax, staying informed about current tax laws. Taxes are probably one of your largest, if not the largest, expenditures. The goal of this chapter is to help you legally and permanently reduce your total taxes. Understanding the tax system is the key to reducing your tax burden. If you don't, you'll surely pay more taxes than necessary. Your tax ignorance can lead to mistakes, which can be costly if the IRS and state government catch your underpayment errors. With the proliferation of computerized information and data tracking, discovering mistakes has never been easier. Focusing on total taxes. Instead of focusing on whether you're going to get a refund when you complete your annual tax return, concentrate on the total taxes you pay. To find out the total income taxes you pay, you need to get out your federal and state income tax returns. On each of those returns is a line that shows the total tax you owed for the year. If you add up the totals from your federal and state income tax returns, you'll probably see one of your largest expenses. Some people feel lucky when they get an income tax refund, but all a refund really indicates is that you overpaid your income taxes during the year. You should have had this money in your own account all along. If you're consistently getting big income tax refunds, you need to pay less tax throughout the year. Fill out a W-4 to determine how much you should be paying in taxes throughout the year. You can obtain a W-4 through your employer's payroll department or from the IRS. If you're self-employed, you can obtain Form 1040-ES by calling the IRS at 800-TAX-FORM, 800-829-3676, or visiting its website, irs.gov. The IRS website also has a helpful withholding calculator at irs.gov/individuals/tax-withholding-estimator. The tax system, like other public policy, is built around incentives to encourage desirable behavior and activity. For example, saving for retirement is considered desirable because it encourages people to prepare for a time in their lives when they may be less able or interested in working so much, and when they may have additional health care expenses. Therefore, the tax code offers all sorts of tax perks to encourage people to save in retirement accounts. Remember, it's a free country, and you should make choices that work best for your life and situation. However, keep in mind that the fewer desirable activities you engage in, the more you will generally pay in taxes. If you understand the options, you can choose the ones that meet your needs as you approach different stages of your financial life. Recognizing the importance of your marginal tax rate. When it comes to taxes, not all income is treated equally. This fact is far from self-evident. If you work for an employer and earn a constant salary during the course of a year, a steady and equal amount of federal and state taxes is deducted from each paycheck. Thus, it appears as though all that earned income is being taxed equally. In reality, however, you pay less tax on your first dollars of earnings and more tax on your last dollars of earnings. For example, if you're single and your taxable income, see the next section, totals $50,000 during 2024, you pay federal tax at the rate of 10% on the first $11,600 of taxable income, 12% on income between $11,600 and $47,150, and 22% on income from $47,150 up to $100,525. Table 1.1 gives federal tax rates for singles and married households filing jointly. Table 1.1. 2024 Federal Income Tax Brackets and Rates. Federal Income Tax Rate, bracket, 10%. Individuals' taxable income, $0 to $11,600. Married filing jointly taxable income, $0 to $23,200. Federal income tax rate, bracket, 12%. Individuals' taxable income, $11,600 to $47,150. Married filing jointly taxable income, $23,200 to $94,300. Federal income tax rate, bracket, 22%. Individuals' taxable income, $47,150 to $100,525. Married filing jointly taxable income, $94,300 to $201,050. Federal income tax rate, bracket, 24%. Individuals' taxable income, $100,525 to $191,950. Married filing jointly taxable income, $201,050 to $383,900. Federal income tax rate, bracket, 32%. Individuals' taxable income, $191,950 to $243,725. Married filing jointly taxable income, $383,900 to $487,450. Federal income tax rate, bracket, 35%. Individuals' taxable income, $243,725 to $609,350. Married filing jointly taxable income, $487,450 to $731,200. Federal income tax rate, bracket, 37%. Individuals' taxable income, $609,350 or more. Married filing jointly taxable income, $731,200 or more. Remember, your marginal tax rate is the rate of tax you pay on your last, or so-called highest, dollars of income. A single person with taxable income of $50,000 has a federal marginal tax rate of 22%. In other words, they effectively pay 22% federal tax on their last dollars of income, those dollars in excess of $47,150. Marginal tax rates are a powerful concept. Your marginal tax rate allows you to quickly calculate the additional taxes you'd have to pay on additional income. Conversely, you can enjoy quantifying the amount of taxes you save by reducing your taxable income, either by decreasing your income or by increasing your deductions. As you're probably already painfully aware, you pay not only federal income taxes but also state income taxes. That is, unless you live in one of the handful of states, Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming, that have no state income tax. Note: some states don't tax employment income, but do tax certain investment income. New Hampshire, dividend and interest income, and Washington, capital gains income. Your total marginal rate includes your federal and state income tax rates, not to mention local income tax rates in the municipalities that have them. Tip: you can look up your state income tax rate in your current state income tax preparation booklet or on the website for the state agency that collects income tax for your state. Defining taxable income. This book explains strategies for reducing your taxable income. Taxable income is the amount of income on which you actually pay income taxes. The following reasons explain why you don't pay taxes on your total income. Not all income is taxable. For example, you pay federal income tax on the interest you earn on a bank savings account, but not on the interest you earn from municipal bonds. Some income, such as from stock dividends and long-term capital gains, is taxed at lower rates. You get to subtract deductions from your income. Some deductions are available just for being a living, breathing human being. In 2024, single people can get an automatic $14,600 standard deduction, and married couples filing jointly get $29,200. People over age 65 and those who are blind get a slightly higher deduction. Other expenses, such as mortgage interest and property taxes, are deductible, subject to limitations, if these so-called itemized deductions exceed the standard deductions. When you contribute to qualified retirement plans, you also effectively get a deduction. Part 4 discusses ways to reduce small business taxes. Being mindful of the second tax system, alternative minimum tax. You may find this hard to believe, but a second tax system actually exists, as if the first tax system weren't already complicated enough. This second system may raise your taxes even higher than they would normally be. Over the years, as the government grew hungry for more revenue, taxpayers who slashed their taxes by claiming lots of deductions or exclusions from taxable income came under greater scrutiny. So the government created a second tax system, the Alternative Minimum Tax, AMT, to ensure that those with high deductions or exclusions pay at least a certain percentage of taxes on their incomes. In its early years of existence, the AMT affected less than 1% of taxpayers, but that number greatly expanded over the decades until it impacted 5 million taxpayers. The Tax Cuts and Jobs Act, which took effect in 2018, reduced the impact back down to its original intent of just a few 100,000 higher-income taxpayers. However, those newer rules are scheduled to expire after 2025, at which time the AMT could hit upwards of 7 million taxpayers. Warning: if you have a lot of deductions or exclusions from state income taxes, real estate taxes, certain types of mortgage interest, and passive investments, for example rental real estate, you may fall prey to AMT. You may also get tripped up by AMT if you exercise certain types of stock options or if you have a high amount of capital gains relative to your other ordinary income. AMT restricts you from claiming certain deductions and requires you to add back in income that is normally tax-free, like certain municipal bond interest. So you have to figure a tax under the AMT system and under the other system, and then pay whichever amount is higher. Warning: beyond April 15th, what you don't know can cost you. Every spring, more than 100 million tax returns and several million extension requests are filed with the IRS. The byproduct of this effort is guaranteed employment for the nation's more than 1 million accountants and auditors and 2 million bookkeeping and accounting clerks, not to mention more than a few textbook authors and their editors. Accounting firms rake in tens of billions of dollars annually, helping bewildered and desperately confused taxpayers figure out all those tax laws. So that you can feel okay about this situation, keep in mind that at least some of the money you pay in income taxes actually winds up in the government coffers for some useful purposes. Given all the hours that you work each year just to pay your taxes and the time you spend actually completing the dreaded return, on April 16th, you may feel like ignoring the whole tax topic until next year. Such avoidance, however, is a costly mistake. You can end up increasing your tax burden and reducing your ability to trim the taxes you owe, and if you file late, you will be subjected to late filing fees with accruing interest. During the tax year, you can take steps to ensure not only that you're in compliance with the ever-changing tax laws, but also that you're minimizing your tax burden. If your income, like that of nearly everyone I know, is limited, you need to understand the tax code to make it work for you and help you accomplish your financial goals. Noting the forever-changing tax laws. Since tax law changes are passed by Congress, they change as the makeup of Congress changes. The most recent major piece of tax legislation was the Tax Cuts and Jobs Act of 2017, which took effect for tax years 2018 and beyond. There have been some smaller pieces of legislation since, addressing retirement accounts and savings, and the COVID-19 pandemic. This section provides the highlights for this more recent legislation and associated tax law changes. The Tax Cuts and Jobs Act of 2017. For most individuals, the biggest change from the Tax Cuts and Jobs Act bill was the lowering of tax rates. The lower tax brackets were lowered by 3 full percentage points, for example, from 15% down to 12%, from 25% down to 22%, and the next income bracket up from that was cut 4 full percentage points from 28% down to 24%, which produced substantial tax savings for lower and moderate income earners. The highest income earning taxpayers saw smaller reductions in their tax brackets. According to Brian Riedel, a senior fellow at the Manhattan Institute, a greater share of the individual income tax benefits from this bill went to lower and moderate income earners. Here are some of the other major changes in this tax bill. Increased standard deduction and eliminated personal exemption. Proponents of the bill like to talk about how the standard deduction nearly doubled. This amount is deducted from your income before arriving at your taxable income, so a larger standard deduction reduces your taxable income and tax bill. However, Congress also eliminated personal exemptions, which offset much of this change. Ultimately, though, far more taxpayers can simply claim the standard deduction, which is a time saver when it comes to completing the annual federal 1040 tax form. Increased child tax credit. The child tax credit was doubled by this legislation, and up to 70% of that credit was made refundable for taxpayers not otherwise owing federal income tax. Also, the incomes at which this credit starts phasing out were more than tripled for married couples and more than doubled for non-married filers. State and local taxes deduction capped at $10,000. This also includes property taxes on your home, and for homeowners in high cost of living areas with high state income taxes, for example, metro areas such as San Francisco, Los Angeles, New York, and Washington, D.C., this cap poses a modest or even significant negative change. Because these taxes are itemized deductions, only being able to take up to $10,000, previously unlimited, caused some taxpayers to no longer be able to itemize. Also, by reducing the tax benefits of homeownership, this change effectively raises the cost of homeownership, especially in high-cost and highly taxed areas. Mortgage interest deduction for both primary and second homes capped at $750,000 borrowed. This represents a modest reduction from the previous $1 million limit on mortgage indebtedness deductibility. The Tax Cuts and Jobs Act also brought some long-overdue corporate tax reform. For too long, the United States had way too high a corporate tax rate, which caused increasing numbers of companies to choose to do less business in the United States. The Secure Acts of 2019 and 2022. Retirement accounts and retirement savings rules were ripe for revisions and improvement. Some of those happened with the Secure, Setting Every Community Up for Retirement Enhancement Act of 2019. Of course, Congress couldn't leave well enough alone, so another bill, the Secure Act 2.0 of 2022, was passed to make yet more changes to retirement accounts. Here are the highlights of these two bills. Small business owners are eligible for up to $5,000 in tax credits when starting a retirement plan. This credit applies to new 401k, profit-sharing, SEP, and SIMPLE plans for small employers, up to 100 employees. More workers can participate in company 401k plans. Previously, employees had to work at least 1,000 hours per year to take part in a company's 401k plan. Now, workers who achieve at least 500 hours over 3 consecutive years may participate. Effective in 2025, employees must be eligible to participate in their employer's qualified retirement plans after 2 years of service. You can withdraw up to $5,000 per parent penalty-free from your retirement plan for the birth or adoption of a child. This new provision waives the normal 10% early withdrawal penalty and allows you to repay the withdrawn money as a rollover contribution. 529 funds can be used to pay down student loans. You can pay down up to $10,000 in student loans and pay for qualifying apprenticeship programs. Employer matching of student loan repayments permitted. Beginning in 2024, employers can elect to match student loan repayments in the form of retirement account contributions. Automatic employee enrollment in company 401k and 403b plans. Beginning with the new 401k and 403b plans in 2025, companies must automatically enroll eligible employees. Increasing retirement plan contribution limits for older workers. As of 2024, workers aged 50 and older are able to contribute $7,500 more per year, increased annually with inflation, than younger workers to most retirement plans. Beginning in 2025, the contribution limits for those aged 60 to 63 increases so that age group may contribute up to $10,000 more per year, increasing annually with inflation, than younger workers in most retirement plans, and $5,000 more annually for simple plans. Required minimum distributions, RMDs, from retirement accounts begin at age 72, not 70 1/2. Effective in 2023, the RMD increased to 73 and then goes to age 75 in 2033. This gives you more options and flexibility, but delaying required distributions that are based upon your life expectancy may or may not be in your best long-term interests. You can make traditional IRA contributions past age 70 1/2, so long as you continue earning employment income. This brings the contribution rules for these accounts into alignment with those for Roth IRAs and 401ks. Inherited retirement accounts must now be tapped and emptied through distributions, generally within a decade. Before, when folks inherited a retirement account, the inheritor could stretch their distributions and associated tax payments out over their life expectancy. For retirement accounts now are inherited from original owners who have passed away in 2020 or later years, most beneficiaries must complete withdrawals from the account within 10 years of the death of the account holder. There are some exceptions to this 10-year rule for retirement accounts left to a surviving spouse, a minor child, a disabled or chronically ill beneficiary, and beneficiaries who are less than 10 years younger than the original retirement account owner. Possible upcoming changes. Congress continually tinkers with our nation's tax laws. Bigger changes tend to occur when the same party controls both chambers of Congress as well as the presidency. As this book goes to press in 2024, Americans have been through a lengthy period where there has been lots of talk of tax increases by the Democrats, the party currently in control of the Senate and the presidency, but that has largely been blocked to date due to their super slim majority in the Senate and by the Republican-controlled House of Representatives. With the 2024 elections on the horizon, history suggests that the most likely outcome from those elections will be continued divided government, which likely will mean more gridlock and less likelihood for tax increases or tax changes in general. Chapter 2. Trimming Your Taxes. In this chapter, lowering your income taxes, claiming deductions, reducing taxes on investment income, being aware of education tax breaks, seeking help from professionals and other tax resources, knowing what to do if you receive an audit request letter. The tax system is built around incentives to encourage desirable behavior and activity. Homeownership, for example, is considered good because it encourages people to take more responsibility for maintaining properties and neighborhoods. Therefore, the government offers numerous tax benefits, referred to as allowable deductions, to encourage people to own homes. See Chapter 13. But if you don't understand these tax benefits, you probably don't know how to take full advantage of them either. Don't feel dumb when it comes to understanding the tax system. You're not the problem. The complexity of the income tax system is. Making sense of the tax jungle is more daunting than hacking away out of a triple canopy rainforest with a dinner knife. That's why, throughout this book, I help you understand the tax system, and I promise not to make you read the actual tax laws. You should be able to keep much more of your money by applying the tax-reducing strategies I present in this book. This chapter summarizes those strategies, and later parts delve into the nitty-gritty for each. Reducing taxes on work income. When you earn money from work, you're supposed to pay income tax on that income. Some people avoid taxes by illegal means, such as by not reporting work income, which isn't really possible if you're getting a regular paycheck from an employer, but you can very well end up paying a heap of penalties and extra interest charges on top of the taxes you owe. And you may even get tossed in jail. This section focuses on the legal ways to reduce your income taxes on work-related income. Self-employed workers and business owners also must pay income tax, but their considerations are subject to some unique rules and can be a bit more complex. Part 4 covers these considerations and more. Contributing to retirement investment plans. A retirement investment plan is one of the few relatively painless and authorized ways to reduce your taxable employment income. Besides reducing your taxes, retirement plans help you build up a nest egg so you don't have to work for the rest of your life. You can exclude money from your taxable income by tucking it away in employer-based retirement plans, such as 401k or 403b accounts, or self-employed retirement plans such as SEP IRAs. If your combined federal and state marginal tax rate is, say, 33%, and you contribute $1,000 to one of these plans, you reduce your federal and state taxes by $330. Do you like the sound of that? How about this? Contribute another $1,000, and your taxes drop another $330, as long as you're still in the same marginal tax rate. And when your money is inside a retirement account, it can compound and grow without taxation. Warning: many people miss this great opportunity to reduce their taxes because they spend all, or too much, of their current employment income and therefore have nothing, or little, left to put into a retirement account. If you're in this predicament, you first need to reduce your spending before you can contribute money to a retirement plan. If your employer doesn't offer the option of saving money through a retirement plan, lobby the Benefits and Human Resources departments. If they resist, you may want to add this to your list of reasons for considering another employer. Many employers offer this valuable benefit, but some don't. Some company decision-makers either don't understand the value of these accounts or feel that they're too costly to set up and administer. If your employer doesn't offer a retirement savings plan, individual retirement account (IRA) contributions may or may not be tax-deductible, depending on your circumstances. You should first maximize contributions to the previously mentioned tax-deductible accounts. Chapter 4 can help you determine whether you should contribute to an IRA, what type you should contribute to, and whether your IRA contributions are tax-deductible. Tip: lower and moderate income earners can gain a federal tax credit known as the Savers Credit. Married couples filing jointly with adjusted gross incomes, AGIs, of less than $76,500 and single taxpayers with an AGI of less than $38,250 can earn a tax credit claimed on Form 8880 for retirement account contributions. Unlike a deduction, a tax credit directly reduces your tax bill by the amount of the credit. This credit, which is detailed in Table 2-1, is a percentage of the first $2,000 contributed, or $4,000 on a joint return. The credit is not available to those under the age of 18, full-time students, or people who are claimed as dependents on someone else's tax return. Table 2-1. Special tax credit for retirement plan contributions. Singles adjusted gross income, $0 to $23,000. Married filing jointly adjusted gross income, $0 to $46,000. Tax credit for retirement account contributions, 50%. Singles adjusted gross income, $23,000 to $25,000. Married filing jointly adjusted gross income $46,000 to $50,000. Tax credit for retirement account contributions 20%. Singles adjusted gross income $25,000 to $38,250. Married filing jointly adjusted gross income $50,000 to $76,500. Tax credit for retirement account contributions 10%. Using health savings accounts. You can reduce your taxable income and sock away money for future health care expenses by taking advantage of a health savings account, HSA. In fact, HSAs can offer superior tax savings versus retirement accounts because in addition to providing upfront tax breaks on contributions and tax-free accumulation of investment earnings, you can also withdraw money from HSAs tax-free so long as the money is used for healthcare costs. No other retirement accounts offer this triple tax-free benefit. Shifting some income. Income shifting, which has nothing to do with money laundering, is a more esoteric tax reduction technique that's an option only to those who can control when they receive their income. For example, suppose your employer tells you in late December that you're eligible for a bonus. You're offered the option to receive your bonus in either December or January. If you're pretty certain that you'll be in a higher tax bracket next year, you should choose to receive your bonus in December. Or suppose you run your own business, and you think that you'll be in a lower tax bracket next year. Perhaps you plan to take time off to be with a newborn or take an extended trip. You can send out some invoices later in the year so your customers won't pay you until January, which falls in the next tax year. Increasing your deductions. Deductions are amounts you subtract from your adjusted gross income before calculating the tax you owe. To make things more complicated, the IRS gives you two methods for determining your total deductions. The good news is that you get to pick the method that leads to greater deductions and hence lower taxes. This section explains your options. Choosing standard or itemized deductions. The first method for figuring deductions requires no thinking or calculating. If you have a relatively uncomplicated financial life, taking the so-called standard deduction is generally the better option. With the tax reform bill implemented in 2018, more people are better off taking the standard deduction. And that is in fact what has been happening, with nearly 9 in 10 taxpayers now taking the standard deduction, down from about 2/3 previously. Single folks qualify for a $14,600 standard deduction, and married couples filing jointly get a $29,200 standard deduction in 2024. If you're 65 or older or blind, you get a slightly higher standard deduction. Itemizing your deductions on your tax return is the other method for determining your allowable deductions. This method is definitely more of a hassle, but if you can tally up more than the standard amounts noted in the preceding paragraph, itemizing will save you money. Use Schedule A of IRS Form 1040 to tally your itemized deductions. Tip: even if you take the standard deduction, take the time to peruse all the line items in Schedule A to familiarize yourself with the many legal itemized deductions. Figure out what's possible to deduct so you can make more informed financial decisions year-round. Purchasing real estate. When you buy a home, you can claim two big ongoing expenses of home ownership as deductions on Schedule A: your property taxes and the interest on your mortgage. You're allowed to claim mortgage interest deductions for a primary residence where you actually live and on a second home for mortgage debt totaling up to $750,000, which is down from the previous limit of $1 million, and a home equity loan of up to $100,000. You may be grandfathered under the higher $1 million limit if your mortgage was taken out before December 16, 2017, or if you had a home under contract by that date and closed on that purchase by April 1, 2018. Before 2018, there was no limit on property tax deductions on Form 1040 Schedule A. Now, property taxes, combined with state and local income tax payments, are limited to a maximum $10,000 annual deduction. To buy real estate, you need to first collect a down payment, which requires maintaining a lid on your spending. Check out Part 5 for more on investing in real estate. Trading consumer debt for mortgage debt. When you own real estate, you haven't borrowed the maximum, and you've run up high-interest consumer debt, you may be able to trade one debt for another. You may be able to save on interest charges by refinancing your mortgage or taking out a home equity loan and pulling out extra cash to pay off your credit card, auto loan, or other costly credit lines. You can usually borrow at a lower interest rate for a mortgage and get a tax deduction as a bonus, which lowers the effective borrowing cost further. Consumer debt, such as that on auto loans and credit cards, isn't tax deductible. Warning: this strategy involves some danger. Borrowing against the equity in your home can be an addictive habit. I've seen cases where people run up significant consumer debt 3 or 4 times and then refinance their home the same number of times over the years to bail themselves out. An appreciating home creates the illusion that excess spending isn't really costing you. But debt is debt, and all borrowed money ultimately has to be repaid, unless you file bankruptcy. In the long run, you wind up with greater mortgage debt, and paying it off takes a bigger bite out of your monthly income. Refinancing and establishing home equity lines cost you more in terms of loan application fees and other charges, points, appraisals, credit reports, and so on. At a minimum, the continued expansion of your mortgage debt handicaps your ability to work toward other financial goals. In the worst case, easy access to borrowing encourages bad spending habits that can lead to bankruptcy or foreclosure on your debt-ridden home. Contributing to charities. You can deduct contributions to charities if you itemize your deductions on Form 1040, Schedule A. Consider the following possibilities. Most people know that when they write a check for $50 to their favorite church or college, they can deduct it. Note: make sure that you get a receipt for contributions of $250 or more. Many taxpayers overlook the fact that you can deduct expenses for work you do with charitable organizations. For example, when you go to a soup kitchen to help prepare and serve meals, you can deduct some of your transportation costs. Keep track of your driving mileage and other commuting expenses. You can deduct the fair market value, which can be determined by looking at the price of similar merchandise in thrift stores, of donations of clothing, household appliances, furniture, and other goods to charities. Some charities will drive to your home and pick up the stuff. Find out whether organizations such as the Salvation Army, Goodwill, or others are interested in your donation. Just make sure that you keep some documentation. Write up an itemized list and get it signed by the charity. Take pictures of your more valuable donations. You could even donate securities and other investments to charity. In fact, donating an appreciated investment gives you a tax deduction for the full market value of the investment and eliminates your need to pay tax on the unrealized profit. Tip: remembering auto registration fees and state insurance. If you don't currently itemize, you may be surprised to discover that your state income taxes can be itemized. When you pay a fee to the state to register and license your car, you can itemize a portion of the expenditure as a deduction on Schedule A, State and Local Personal Property Taxes. The IRS allows you to deduct the part of the fee that relates to the value of your car. The state organization that collects the fee should be able to tell you what portion of the fee is deductible. Some states detail on the invoice what portion of the fee is tax deductible. There's a $10,000 annual federal income tax deduction limit on all deductible state and local taxes combined with property tax payments on your home. Several states have state disability insurance funds. If you pay into these funds, check your W-2, you can deduct your payments as state and local income taxes on Schedule A. You may also claim a deduction on this line for payments you make into your state's unemployment compensation fund. Tip: deducting self-employment expenses. When you're self-employed, you can deduct a multitude of expenses from your income before calculating the tax you owe. If you buy a computer or office furniture, you can deduct those expenses. Sometimes they need to be gradually deducted or depreciated over time. Salaries for your employees, office supplies, rent or mortgage interest for your office space, and phone communications expenses are also generally deductible. Many self-employed folks don't take all the deductions they're eligible for. In some cases, people simply aren't aware of the wonderful world of deductions. Others are worried that large deductions will increase the risk of an audit. Spend some time finding out more about tax deductions. You'll be convinced that taking full advantage of your eligible deductions makes sense and saves you money. Part 4 discusses small business deductions and other considerations for small business owners. Lowering investment income taxes. The distributions and profits on investments that you hold outside of tax-sheltered retirement accounts are exposed to taxation. Interest, dividends, and capital gains, profits from the sale of an investment at a price that's higher than the purchase price, are all taxed. The good news: you can take action to reduce the taxes in those accounts. When you invest, you can invest in a way that fits your tax situation. This strategy can make you happier and wealthier come tax time. For example, you can choose tax-friendly investments, such as tax-free bonds. They reduce your tax bill and increase your after-tax investment returns. Part 3 explains how investment income is taxed. The chapters in that part help you consider an investment strategy that works for your situation. Enlisting education tax breaks. The U.S. tax laws include numerous tax breaks for education-related expenses. Here are the important tax reduction opportunities you should know about for yourself and your kids if you have them. Tax deductions for college expenses. You may take up to a $2,500 tax deduction on IRS Form 1040 for college costs as long as your modified adjusted gross income, AGI, is less than $80,000 for single taxpayers and less than $165,000 for married couples filing jointly. Note: you may take a partial tax deduction if your AGI is between $80,000 and $95,000 for single taxpayers and between $165,000 and $195,000 for married couples filing jointly. Tax-free investment earnings and special accounts. Money invested in Section 529 plans is sheltered from taxation and is not taxed upon withdrawal as long as the money is used to pay for eligible education expenses. 529 plans allow you to sock away more than $200,000. However, funding such accounts may harm your kids' qualifications for financial aid. American Opportunity Tax Credit. The American Opportunity Credit provides tax relief to low and moderate income earners facing education costs. The full credit, up to $2,500 per student, is available to individuals whose modified adjusted gross income is $80,000 or less, or $160,000 or less for married couples filing jointly. The credit is phased out for single taxpayers above $90,000 and married couples filing jointly above $180,000. The credit can be claimed for expenses for the first 4 years of post-secondary education. You may be able to claim an American Opportunity Tax Credit in the same year in which you receive a distribution from either an ESA or 529, but you can't use expenses paid with the distribution from either an ESA or 529 as the basis for the American Opportunity Credit. Lifetime Learning Tax Credit. The Lifetime Learning Credit may be up to 20% of the first $10,000 of qualified educational expenses, up to $2,000 per taxpayer. For parents filing tax returns, only this credit or the American Opportunity Tax Credit may be claimed for each child per year. Single taxpayers phase out for being able to take this credit is at modified adjusted gross incomes, MAGIs, of $80,000 to $90,000. Other taxpayers phase out is from $160,000 to $180,000. Getting help from tax resources. There are all sorts of ways to prepare your tax return. Which approach makes sense for you depends on the complexity of your situation and your knowledge of taxes. Regardless of which approach you use, you should be taking financial steps during the year to reduce your taxes. By the time you actually file your return in the following year, it's often too late for you to take advantage of many tax reduction strategies. Obtaining IRS assistance. If you have a simple, straightforward tax return, filing it on your own using only the IRS instructions is likely fine. This approach is as cheap as you can get. The main costs are time, patience, photocopying expenses. You should always keep a copy of your files, and postage for mailing the completed tax return, unless you're filing electronically. Warning: IRS publications don't have tip or warning icons, and the IRS has been known to give wrong information from time to time. When you call the IRS with a question, be sure to take notes about your conversation to protect yourself in the event of an audit. Date your notes and include the name and identification number of the tax employee you talked to, the questions you asked, and the employee's responses. File your notes in a folder with a copy of your completed return. Tip: in addition to the IRS's standard tax return preparation instructions, the IRS offers some free, actually paid for with your tax dollars, and sometimes useful booklets. Publication 17, Your Federal Income Tax, is designed for individual tax return preparation. Publication 334, Tax Guide for Small Businesses, is for, you guessed it, small business tax return preparation, particularly those small business owners who use Form 1040 Schedule C. These publications are more comprehensive than the basic IRS instructions. Call 800-829-3676 to request these booklets, or visit the IRS website at irs.gov. Consulting Preparation and Advice Guides. Tip: books about tax preparation and tax planning that highlight common problem areas and are written in clear, simple English are invaluable. They supplement the official instructions not only by helping you complete your return correctly, but also by showing you how to save as much money as possible. Check out the latest edition of Taxes for Dummies, which I co-authored, and my Small Business Taxes for Dummies, both published by Wiley. Using software and websites. Tip: if you have access to a computer, good tax preparation software can be helpful. TurboTax, H&R Block Tax Software, and Tax Slayer are programs that I have reviewed and rated as the best. If you go the software route, I highly recommend having a good tax advice book by your side. For you web surfers, the Internal Revenue Service website, irs.gov, is among the better Internet tax sites, believe it or not. Hiring professional help. Competent tax preparers and advisors can save you money, sometimes more than enough to pay their fees, by identifying tax reduction strategies you may overlook. They can also help reduce the likelihood of an audit, which can be triggered by blunders. Mediocre and lousy tax preparers, on the other hand, may make mistakes and be unaware of sound ways to reduce your tax bill. Tax preparers and advisors come with varying backgrounds, training, and credentials. The four main types of tax practitioners are preparers, enrolled agents, EAs, certified public accountants, CPAs, and tax attorneys. The more training and specialization a tax practitioner has, and the more affluent their clients, the higher their hourly fee usually is. Fees and competence vary greatly. If you hire a tax advisor and you're not sure of the quality of the work performed or the soundness of the advice, try getting a second opinion. Preparers. Preparers generally have the least amount of training of all the tax practitioners, and a greater proportion of them work part-time. As with financial planners, no national regulations apply to preparers, and no licensing is required. Preparers are appealing because they're relatively inexpensive. They can do most basic returns for around $100 or so. The drawback of using a preparer is that you may hire someone who doesn't know much more than you do. Tip: preparers make the most sense for folks who have relatively simple financial lives, who are budget-minded, and who hate doing their own taxes. If you're not good about hanging on to receipts or you don't want to keep your own files with background details about your taxes, you should definitely shop around for a tax preparer who's committed to the business. You may need all that stuff someday for an audit, and many tax preparers keep and organize their clients' documentation rather than return everything each year. Also, going with a firm that's open year-round may be a safer option. Some small shops are open only during tax season, in case tax questions or problems arise. Enrolled Agents, EAs. A person must pass IRS scrutiny in order to be called an enrolled agent. This license allows the agent to represent you before the IRS in the event of an audit. Continuing education is also required. An EA's training is generally longer and more sophisticated than that of a typical preparer. Enrolled agents' fees tend to fall between those of a preparer and a CPA. See the next section. Returns that require a few of the more common schedules, such as Schedule A for deductions and Schedule D for capital gains and losses, shouldn't cost more than a few $100s to prepare. Tip: EAs are best for people who have moderately complex returns and don't necessarily need complicated tax planning advice throughout the year, although some EAs provide this service as well. You can get names and telephone numbers of EAs in your area by contacting the National Association of Enrolled Agents, NAEA. You can call the NAEA at 202-822-6232 or visit its website at naea.org. Certified Public Accountants, CPAs. Certified public accountants go through significant training and examination before receiving the CPA credential. In order to maintain this designation, a CPA must complete a fair number of continuing education classes every year. CPA fees vary tremendously. Most charge $150 plus per hour, but CPAs at large companies and in high cost-of-living areas tend to charge somewhat more. Tip: if you're self-employed and/or you file lots of other schedules, you may want to hire a CPA. But you don't need to do so year after year. If your situation grows complex one year and then stabilizes, consider getting help for the perplexing year and then using preparation guides, software, or a lower-cost preparer or enrolled agent in the future. Tax attorneys. Tax attorneys deal with complicated tax problems and issues that usually have some legal angle. Unless you're a super high-income earner with a complex financial life, hiring a tax attorney to prepare your annual return is prohibitively expensive. In fact, many tax attorneys don't prepare returns, but they may offer tax preparation as an ancillary service through others in their office. Because of their level of specialization and training, tax attorneys tend to have the highest hourly billing rates. $300 plus per hour is not unusual. Dealing with an audit. On a list of real-life nightmares, most people would rank tax audits right up there with root canals, rectal exams, and court appearances. Many people are traumatized by audits because they feel like they're on trial and being accused of a crime. Take a deep breath and don't panic. You may be getting audited simply because someone at the IRS or a business that reports tax information on you made an error regarding the data on your return. In the vast majority of cases, the IRS conducts its audit by corresponding with you through the mail. Audits that require you to schlep to the local IRS office are the most feared type of audit. In these cases, about 20% of such audited returns are left unchanged by the audit. In other words, the taxpayer doesn't end up owing more money. In fact, if you're the lucky sort, you may be one of the 5% of folks who actually gets a refund because the audit finds a mistake in your favor. Unfortunately, you'll most likely be one of the roughly 75% of audit survivors who end up owing more tax money. The amount of additional tax that you owe in interest and penalties hinges on how your audit goes. Warning: whatever you do, don't ignore your audit request letter. The IRS is the ultimate bill collection agency, and if you end up owing more money, the unhappy result of most audits, the sooner you pay, the less interest and penalties you'll owe. Certified tax professionals such as an EA or CPA can help take some of the sting out of dealing with an audit, but you will still need to do some legwork on your own. For information on preparing for an audit, see the most recent edition of my book, Taxes for Dummies. 2. Personal finance and taxes. In this part, find out how to make tax-wise personal finance decisions. Utilize a retirement account to slash your income taxes. Make the most of your children's tax reduction opportunities. Plan your estate for minimal hassle and taxes.